Welcome to the Opening Bell Report.
Today into a company called Plus Therapeutics, ticker PSTV. And we're focusing on a financial setup that it presents what looks like a classic, almost unbelievable discount opportunity.
It really is a textbook lesson in market psychology.
Right.
You know, what happens when mass panic just completely overrides any kind of sober long-term analysis?
Right.
So our mission for you, the listener, is to kind of move past that temporary chaos and really analyze the institutional arbitrage opportunity here.
Okay.
We're zooming in on this paradox. Institutions paid 38 cents.
And you can pay 29.
Exactly.
Yeah.
What does that nearly 25% difference signal about the company's true immediate valuation?
That paradox is the hook. I mean, that's what grabbed us. Just imagine you had the chance to buy the exact same asset that these massive, sophisticated institutional investors just bought.
Yeah.
But you get to pay almost 25% less. That's the core setup we're unpacking.
Yeah.
We're looking at a situation where the so-called smart money is instantly underwater on paper.
And yet the public is being offered this immediate, hefty discount that's basically engineered by fear. A deep dive into a temporary mispricing.
Driven by external pressure, not some kind of internal failure.
Right. And understanding the source of the crash isn't just academic. It's crucial for telling the difference between a real opportunity and a disaster. If you just see that 38% crash and run, you miss everything.
So let's address the elephant in the room right away. PSTV stock crashed 38% today. It closed at just 29 cents. When people see a drop like that, the immediate assumption, that gut reaction, is always doom.
Right. Oh, absolutely. Bad data.
Bad clinical data, a regulatory failure, a lawsuit, something catastrophic.
That is the default survival instinct market reaction. But here's where the story gets really interesting. The catalyst for this drop was not bad clinical news.
Okay.
The drug pipeline fundamentals have not changed at all. What caused this massive drop was purely a financing decision.
A financing decision.
The announcement of a public offering priced to raise $15 million.
A capital raise. So the company decided to bring in cash, and the market reacted violently.
Yeah.
Why does raising cash, which on the surface seems like a good thing for a biotech, cause such a collapse?
It comes down to one word, really. The fear of dilution.
Dilution.
Think of it like a pizza. If you own one slice, you own a certain fraction of the whole thing.
Okay.
When a company prints new shares to sell, they're essentially taking that same pizza and just cutting it into more slices. Your original slice is now a smaller percentage of the whole pizza.
Right.
And that collective fear, that emotional reaction, it immediately pushes the stock price down, the market reacts first, and it asks questions about the benefit of the cash later. Much later.
So it's an emotional knee-jerk reaction. It's not based on a fundamental reassessment of the drug's actual value.
Precisely. And the critical insight here is that the market overreacted. The panic selling pushed the public price all the way down to 29 cents.
And that number is so important because it's significantly below the price that major institutional investors just agreed to pay.
Exactly.
Okay, so let's highlight those numbers again because this is the core of the whole arbitrage setup we're looking at. The institutions, the smart money with teams of PhDs vetting these deals, they agreed to pay 38 cents per share.
To participate in that $15 million raise.
And you, the public, are currently able to buy the exact same stock at the panic-induced closing price of 29 cents.
It's a huge disconnect.
Wait a minute, though, before we jump to conclusions. Doesn't the fact that the institutions are instantly down 25% on paper just prove that they misjudged the dilution panic, too?
That is a critical question.
Why should we trust their entry point of 38 cents as some kind of stable floor?
Okay, so the nuance here lies in the structure of the offering itself. It's something the average person doesn't see.
Okay.
When institutions enter a capital raise like this, that 38-cent price they paid, it isn't just for the stock. They typically get a sweetener. It's often in the form of warrants or other options, which makes the deal attractive to them even if the stock price dips right away.
So 38 cents wasn't the market price. It was a negotiated price that came with perks the public doesn't get buying on the open market.
Exactly. But here's the massive takeaway. Even with those sweeteners, that 38-cent price represents their minimum baseline of conviction.
Right.
They did their due diligence and agreed that the inherent long-term value of this company is significantly higher than 38 cents. They aren't betting on next week. They're committing $15 million for the next 2 or 3 years of development.
So that makes the 38-cent price a kind of a psychological magnet for the stock. It's not an arbitrary number. It's a tangible commitment.
It is. It establishes a soft floor. For the stock to stabilize, reclaiming 38 cents is the first, most logical step. It means the price is back in line with what the big players value it at.
Until then, you're getting it for less.
Less than the cost of entry for the pros.
Okay, so we've established the psychological floor at 38 cents, but that's worthless if the company's foundation is crumbling. What research did they do on the actual drugs that justifies this confidence?
Right. We need to shift from the panic to the fundamentals. And the single most critical argument the panic sellers are ignoring right now is the cash position.
Okay.
Before this raise, the company was, let's be honest, in a precarious spot financially. Cash was tight. That creates what analysts call bankruptcy risk.
And bankruptcy risk is absolute kryptonite for biotech companies, right?
Hey.
Especially with long, expensive cancer trials.
It forces them to worry about survival instead of science. But now, the $15 million, it removes that existential threat.
It's gone.
If we look at the pro forma cash position, which is just a fancy way of saying how the balance sheet looks after the cash comes in, it's now over $30 million.
Let's define that for the listener. What's the practical significance of having $30 million in the bank for a biotech this size?
It means they have a massive runway. According to the analysis, that cash funds their operations through 2026, maybe even into 2027.
Wow.
That level of security is transformative. It lets management focus entirely on their clinical plan, their trials for cancer therapies, without being forced into another desperate, dilutive raise every 6 months just to survive.
So the company has basically traded a short-term dilution event for 2 to 3 years of financial stability. They've removed the single biggest risk factor.
That is the essential trade-off.
Yeah.
The business is fundamentally stronger today than it was yesterday.
Even though the stock price is saying the exact opposite.
Exactly. And if you look closer, the stock is now trading near its cash value. This is a crucial metric that signals a deep, deep discount.
Trading near cash. Explain why that matters so much in this world.
It means the market has assigned almost zero value to the company's entire drug pipeline.
None.
The price only reflects the dollars sitting in the bank. It's like the market is saying, we value the cash, but we assume all your cancer drugs are worthless.
Which is a huge psychological discount on assets that, if they work, could be worth billions.
And that's what the analysts who put out those $7 price targets are valuing. They're valuing the drugs, not the cash.
That's the key distinction. The $7 consensus is based on their lead candidate, this rhenium-186 nanoliposome, successfully treating a really aggressive brain tumor.
A tumor where there are very few effective options. That success scenario is what the institutions are betting on.
So their commitment at 38 cents confirms they believe in that potential, which makes the current 29-cent price look completely out of sync with the asset.
Especially now with the new financial stability.
Okay, let's review the potential return metrics here, just to emphasize the skewed risk-to-reward ratio that this panic has created.
Starting with the most conservative target, just matching the institutional price.
Yeah.
Getting back to 38 cents.
Yeah.
That represents a 31% upside from 29 cents. Just get back to the floor.
But the really compelling part is the potential of the drugs they now have the cash to fund. And, we should always take analyst numbers with a grain of salt.
Always.
But their current consensus is over $7 a share.
Which reflects success in the trials. But even if we apply a massive discount to that, say the analysts are wrong by 50%.
Okay.
A move to 350 would still be a 10x return from these levels. The risk is minimized by the cash runway. The reward is magnified by the discounted pipeline.
Now let's look at the technical signals from the day of the crash itself. The price action tells a story. The stock hit an intraday low of 25 cents, but it fought back and closed at 29. That rally off the bottom on a huge down day is, well, it's suggestive.
It suggests buyers were already stepping in aggressively when the panic peaked. And if you look at the after-hours trading,
it bounced again.
It accelerated. The stock jumped over 8% to 31 cents almost immediately.
And this huge volume on the down day, people call that capitulation volume. Can you break down why that term matters?
Yeah, absolutely. Capitulation is really just a fancy word for surrender.
Okay.
It means we saw massive trading volume, and it signals that all the quick sellers, the weak hands, the retail investors reacting purely to the news, they finally panicked and dumped their shares. The market is exhausted of sellers.
And when the weak hands sell out, who's on the other side of that trade? Who's buying?
That's when the value hunters step in. The investors who understand this arbitrage setup, they see the mispricing and they absorb the shares. So the high volume confirms a major rotation of ownership just happened.
From fearful short-term holders to more confident tactical investors.
Precisely.
So we have the 38-cent institutional floor as the immediate target. What about key resistance levels if the stock does manage to reverse from here?
The first major hurdle is definitively that 38-cent price. Reclaiming that level on high volume would validate the whole institutional thesis.
It signals the market has accepted the trade-off, dilution in exchange for cash.
Right. And if the stock can break through 38 cents, the path gets clearer. The next significant level is filling the price gap back up to the old support and resistance zone. which is around 47 cents.
That makes the trade framework very clean then. Entry at the panic price, target the institutional floor, and then look to that old trading range for more upside.
Exactly. The setup is defined by those price points because they're driven by real financial commitments in history.
So what does this all mean for the listener? The final verdict, based on the analysis, is that this is a classic overreaction play.
It is. The drug pipeline fundamentals have not changed. Only the share count has.
And critically, the company's cash strength is massively improved. They've moved from precarious to secure funding through 2026, maybe 2027.
The reduction of bankruptcy risk is a huge fundamental positive that the short-term noise has just completely drowned out. The ultimate takeaway is being able to distinguish between market panic
Fear of dilution
and underlying fundamental improvements like a $30 million cash runway.
It's a textbook example of volatility creating value that you rarely get to see in such stark numerical terms.
And it raises a really important question for you, the listener, to consider. If sophisticated institutional investors were willing to absorb a massive, instant on-paper loss, entering at 38 cents when the stock is at 29,
Right.
because they believe the long-term potential of the cancer pipeline outweighs that temporary discount.
Right.
What does that teach us about the true difference between short-term market noise and genuine, well-researched valuation?
Is your perspective short-term, or are you looking where the institutional money is truly focused?
Don't forget to like, share, and subscribe for more.